Welcome to Real Talk, Real Estate Discussions with Andrew Kirsch. In each episode, Andrew interviews industry leaders. We'll hear their real-time opinions on today's market, their background and unique career highlights, and guidance for newcomers into the industry. You can find this show at skalalkirsch.com and on YouTube, LinkedIn, Apple Podcasts, Spotify, Google Podcasts, and more. Now here's the host of Real Talk, Andrew Kirsch.
Episode 23 of Real Talk. Well, there's something happening that hasn't happened in about the last 5 months of the year, and that's an uptick in transactional volume. Unsure if it's a coincidence or it's a sign that deal flow is starting to come back and that there's finally price discovery. We have 2 new multifamily deals in Orange County, a new multifamily deal in the state of Washington, an industrial deal in Southern California. We got a couple of retail deals, among others. So it's nice to see. I still am a bit cautious. I feel the summer will be slow, but I do think third and fourth quarters will gain in transactional volume. Nothing like we saw in 21 or early 22, but at least it's an uptick. On this week's episode, we've got Dan Rosenbloom, the Chief Investment Officer of Cadre, whose tagline is revolutionizing commercial real estate investing. I had a very interesting conversation with Dan. He talks about his crowdfunding business and how they provide JV equity to real estate owners and operators. They also offer their LPs liquidity on a quarterly basis by matching up their investors that want to sell with investors that want to come into existing deals. I call them the J-date of real estate capital allocators. They're a big user of technology to digest real estate data. And they act more like a traditional private equity firm. They have a balance sheet of $250 million to take down deals before they even syndicate. In total, they put out $1.5 billion in equity and $5 billion of real estate value. I hope you enjoy our conversation that I had with Dan.
Welcome to another episode of Real Talk. I'm here with my buddy Dan Rosenbloom, Chief Investment Officer of Cadre. Dan, how you doing?
I'm great. Could be better if I was in LA, but unfortunately I'm in Chicago where the weather's not as fun as where you are, man.
No, but Chicago's my second town. So Chicago's a great city, but I would say it's even better between Memorial Day through a little bit of fall. I'll say Memorial Day through Thanksgiving.
All right, I'll give you that. And considering LA was my hometown growing up, like I feel like, I have 2 towns, but I'm with you. We're coming into the summer months here, so it's exciting. No snow right now on the ground.
That's awesome. So you're making history today, Dan. You know how?
I don't know how. How am I making history?
I think you and Cadre, you are the first guest of Real Talk in which you are neither a client nor an opposing or a party in which I've transacted with.
Oh, wow.
You're just a civilian.
Just a civilian that we've known each other for many, many years, going to seeing each other at IMN every year.
So what does that say about me, or what does that say about you, that we've known each other casually through different conferences, but yet have never transacted? Is it you or is it me?
I think it's both. It's both of us, Andrew. I think part of it is, for better or worse, like I use a lot of my legal work is through my best friend. So I won't plug them here, but I do other guys. We should be doing more business together. Now that I think about it,
I'm just giving you shit. My responsibility in life is to find you deals, and so that's what I do on a weekly basis. But none of them are good enough, I guess, for Cadre. But let's talk about Cadre, and let's get right into your tagline on your website. And I'm going to quote it.
Okay.
We are revolutionizing commercial real estate investing. Yeah. How are you revolutionizing commercial real estate investing? What's in the secret sauce here?
Yeah, I mean, look, it depends on who you are and what you're looking for. Where we're unique is, we have a firm that is kind of half real estate investment firm and half technology company, right? And very different from my prior lives. I've been here almost 7 years now, and helping to grow out the platform on the investment side of the business. And that's where my background is, right? Prior to that, I spent 11 years at a traditional private equity real estate shop. I was at a hedge fund for a little bit after grad school, and then started my career at a real estate services firm called now JLL, which was LaSalle Partners back in the 90s when I started. So I'm a real estate guy, but in terms of what we're doing differently is, we're doing things from a technology perspective to really help in two different ways. One is to democratize real estate investing a little bit, right? Which is to allow access to our investments to people who might not have access to, big funds like at PIMCO or at Walton Street, or I'm going to give some, I guess, some shout outs to some of these firms, Angela Gordon, Blackstone, right? Not everybody has the ability to invest with those, great real estate investors and have the opportunity to kind of get into institutional real estate. So that's kind of part of the technology, and we'll walk through why that's, how the technology is helping to democratize real estate. And the other side is really liquidity. Part of what we try to offer our LPs is liquidity on a quarterly basis. And in order to have liquidity, you got to have really good information, and you got to be able to have the technology to onboard and really, digest and ingest data that's out there, right? Real estate investing tends to be known as a little bit of a dinosaur when it comes to technology, especially when it comes to investing in valuations of properties. Because as there's tons of markets, tons of assets out there, but the information tends to be stale and it tends to lag. What we're trying to do with technology, one component of it is to really leverage technology to scale our operations without throwing thousands of people at it. Like a larger firm that has 30, 40, $50 billion of AUM can really throw people at problems. We want to be a little bit smaller, a little bit more nimble. And so in order to do that, in order to kind of get the scalability we want to get, as it pertains to onboarding lots of investors, in terms of getting reporting, in terms of having transparency, you need to use technology to help really kind of ingest that data and put it out in a form that is helpful and useful for not only the investments team internally, but also for our investor base externally. And then there's a lot of nuances internally where we use technology to help us be better investors. And what does that mean? We have data scientists in-house that help us really kind of create our own algorithms to go after markets that we think might outperform what the broader market thinks. But we also have technology that enables us to move quicker and see data faster than a traditional what I had at my traditional shop. So both on the acquisitions front in terms of seeing new deals, as well as asset management in terms of disseminating and really looking and dissecting the performance of our assets for our investors. And what that does is that information that is dissected much quicker and have more transparency in terms of how the performance of our assets are, I think leads to a little bit more potential for liquidity. Now, don't get me wrong, we haven't created a liquid asset class here yet. But what we do is we open our quarterly windows. We allow our LPs to try to trade in and out of specific individual deals on a quarterly basis based on our valuations and the information we provide our investors to value it.
So there's a lot to unpack here, and I want to get into I want to get into the real estate, the types of real estate that you guys invest in, but also the types of investors. So to the extent you can talk about that. So let's first talk about the type of investors. And are you similar to a crowdfunding company like a Realty Mogul or a Crowdsource?
So a lot of people equate us to crowdfunding sites. And what I say is this: we do compete in some level for investors. We're a very different platform in that a lot of the crowdfunding sites, and I'm not going to name names, but a lot of them are much more like a private placement agent, right? What does that mean? They basically take an operator and an investor and they put them together, and then they kind of are, they take a fee for that. Where we're different and more alike to a private equity real estate fund is that we're going to be underwriting every deal that we do. So that's important from the perspective of diving deep and understanding and curating a portfolio for our investors. Two, which is actually one of the more important points, which I usually make first, but you have me rattled here. So I would say that we have a balance sheet of about $250 million from a family office that allows us to take down deals and then syndicate after the fact. What does that mean? That allows us to signal to the market that we're not, a buyer of last resort. In other words, we have the capital to close, and that's really important for credibility, not only with the sellers but also with operators who bring me deals, right? So every deal we do, we bring a local operator with us, or they bring us a deal, right? So we're going to do 90-10, 80-20 transactions with people who have local expertise or asset class expertise, depending on the deal. So with that, we're also going to be curating a joint venture relationship that is much more akin to a private equity fund, where Cadre controls the major decisions, since we are the majority of the capital. So we'll have a JV document in place, which you know very well, which dictates how decisions get made at the asset level. My investments team not only acquires assets, but we also actively asset manage, Andrew. So unlike, I think, some of these other places, we're working with our operator and augmenting their, obviously their expertise with our expertise as well. So it ultimately benefits our investor in the long run to have kind of the alignment, as well as, obviously our decision-making ability on each asset. And then, finally, we do invest alongside of our investors on every deal that we do. So we are trying to align ourselves not only on the downside, but also the upside with, the promote share with the operator.
Sure. So when you take down assets with this family office, is the intention that every deal will then go onto your website to be then syndicated out? Or do you ever, or does that family office ever say, hey, I want to keep this on our portfolio?
Yeah, no, it's all a line of credit from that standpoint. So
Sure.
it is always intended to be syndicated out. And if you back up, like right now, we have kind of, if you look at the last 7 or 8 years of Cadre, we've been around about 8 years. I've been here almost 7. We've put out about $5 billion worth of real estate, about $1.5 billion ish of equity, over about 50 transactions in that time frame. When you look at what we've syndicated, what we haven't, from that standpoint, we've started doing deal by deal transactions, Andrew. So we'd find a deal that we like, we would then underwrite it, put it through our investment committee, and then close on the transaction and then syndicate it on our platform. What we're doing today, as we've evolved and as we kind of figured out what we think investors really want, is created funds. So currently, right now, we're investing our first value add fund, which we're actually closing our last transaction in that fund, Andrew, and we've launched Fund 2, which is about a $500 million raise for a value add fund. But it's going to look and smell a lot more like a close-end fund structure, meaning that, from an investor perspective, if you go on our website at cadre.com, you can invest in the fund, which will be a portfolio of assets ultimately that will, kind of, if you look at about 500 million of equity with, call it 65% leverage, you're talking about buying power of, call it 2 billion or so of real estate. With the size deals that we do, that's going to be a curated portfolio, about 15 to 20 assets. So that's a pool of capital that you can invest in just a blind fund. But on each deal that we do in that value add fund, we do launch somewhere around $3 to $5 million of each deal, and they tend to be, on average, Andrew, but between 15 and $50 million of equity per deal. So 3 to 5 million of that we will launch on our site for deal by deal investment opportunities for our platform. So you can't go on and invest in a single deal. We also have another fund that we've launched, which is called the Horizon Fund. So that first value add fund is called the Cadre Direct Access Fund 2. The Horizon Fund is much more of a core plus, longer dated, and what will ultimately be an open-end fund structure that allow people to kind of come in and come out. It's more of a kind of I look at it as a 7 to 10 year time horizon, where hence the horizon fund, where we're going to create value. 50% or so roughly is targeted, with value through cash flow generation on the asset, and then 50% of the value creation is going to be really just asset value creation over that, call it 5 to 10 year period of time. Whereas the Cadre Direct Access Fund 2, the value add fund, is much more of a 3 to 5 year type play, where we come in, we add value, whether it's through development, capital infusion, or some operational expertise, create the value, stabilize the asset, and then exit to more of a core buyer to generate the value and the returns.
So a couple remaining questions on your investors, and then let's pivot over to the real estate side.
Yep.
So what would you say is the average investor invests how much we'll go deal by deal, and then also in your fund?
Yeah, so deal by deal, you can go as low as $10,000 per deal.
Mm-hmm.
I would say it's kind of one of those things where the average check size ends up being closer to $250, because we have people investing $10,000 to $200,000, a lot of those. But then we have individuals coming in for the deal by deal, Andrew, of over $1 million. For the fund, it's different. The Cadre Direct Access Fund 2, our minimum investment size there is $50,000. One really important point is, it's all accredited investors for that value add fund. Obviously we have FINRA and certain SEC regulations, but it's all accredited investors. So when you look at the composition of the investors of this, let's say the $500 million fund we're raising, I would say about a third or so of it will be institutional capital, like traditional, endowments, pension funds, and things like that. So call it, 150 to 200 million. We're probably earmarking for that, maybe a little bit more. Another 100 or 200 is going to be like high net worth family offices, which is similar to institutional in terms of the way you raise it. And then about a third of it will be through our platform. So raising $50,000 to $50,000 minimum checks up through, we've had investors come in through the platform, almost to close to $10 million per investor. So the average check size ends up being, probably closer to $200,000-$300,000, because you do have, a big portion that are kind of in that 50 to 200,000, but the bigger checks tend to, kind of pull it a little wider. Within the Cadre Direct Access Fund, we are in the process of registering that fund, Andrew. So at some point it will be registered, and at some point it will be it will have the ability to access everybody. And our check sizes will be much smaller. But right now, that's a private fund that we're raising, where the smallest check sizes are $10,000 per investor.
And so you talk about the liquidity features, and so even going back on any deal that an investor invested $10,000, $20,000, can they call you up or email you and say, I want out as of Q2, and you write them a check? Or how does it work?
No, it's not quite that simple, Andrew. So what we'll do is every quarter we'll open up the liquidity window for a bunch of our assets. And what we'll do is we're going to match. Right now we match buyers and sellers. So we'll put out there our own internal valuation of the asset. We have third party valuation. So it's all been validated through third party as well as our internal analysis. And then we'll put out what we think is the value. And so you'll have the ability to say, hey, I want to buy or I want to sell at that price point with those returns. And then we match buyers and sellers at this point in time. So
you're StubHub.
for that, yes. For the liquidity window, yes, we are more akin to a matchmaker than we are, an investor. It's the primary stuff, on the value add fund and the Horizon Fund, as well as we've done opportunity zones on a one-off deal perspective where we put out there. Those are all, principled by Cadre and underwritten.
So you're revolutionizing commercial real estate investing because you're the J date of real estate allocators.
You and I can laugh at that one because we probably both know what that is. But I guess for analogy purposes, I usually go sports. But if you want to go there, I'm happy to.
I'll go anywhere. You're my conference buddy. All right, let's flip over to the real estate side. So
yeah.
I've sent you many deals. I think you passed on all. So what is the box that you're looking for today? Both asset class, size, geographical location, and is Cadre? Because there's a lot of real estate private equity companies. They say they're open for business. They're really window shoppers, and they're not.
Yeah, so there are lots to unpack there.
Yeah,
What I tend to say is, we're a little bit different than like kind of the multi-billion-dollar funds, right? Like I like to use the old analogy, and I'm sure you'll catch the movie analogy here. If we act like Blackstone in here, we will lose to Blackstone out there. And that's a nice analogy I've used from Moneyball, and I'll steal that
yeah,
one all
of
day
course.
long. Like more like the Oakland A's, back in the early 2000s. We're sharpshooters. We're not going for the big macro bets, right? We don't have billions and billions. We're trying to curate about a 15 to 20 asset portfolio for a value add fund. And so how do we do that? Well, we like to stay under 50 million of equity. We think once you start to get into that 50 million of equity and higher, a lot of these $1 billion funds are competing for assets. And we feel when you look at the statistics, they're actually the returns over the course of many cycles that deal size tends to outperform the larger deals. And we've seen that in statistics. So there's one way technology has helped us kind of disseminate where the best target audience is. But so that tends to be, somewhere between 50 to $250 million assets, right, with leverage. So we stay there, and we try to stay in our lane from that standpoint. And then you look at what's happening in the environment today. I kind of say, to our team, we're in a yellow light mode. We're very cautious right now. We are closing on 2 transactions though right now. One is an assumption of debt with a multifamily deal, newer asset. That is in a market that we really like. I like to think that, when you talk about sharpshooting, you can find good micro deals in any bad macro environment. And I think that's what we're trying to do is we're trying to utilize our relationships on the ground with the top tier operator network that we do have, and augment that with the technology and the data science that we're using in-house to curate a portfolio. So when you asked about markets, we do have something called the MVP. It's our most valuable places where we try to identify every quarter what we believe to be the top 10 to 15 markets to proactively look at. So when I talk to the investments team about, sourcing opportunities, we spend about 80% of our time sourcing deals in those 10 to 15 markets that we've identified that we believe will generate more alpha through our market algorithms, right? That look, hedge funds have been doing it for years. They create their own algorithms to try to beat the market. Why can't commercial real estate do it? We can. So we're doing a little bit of that. And then I say the other 20% of the time we're reacting to really good operators who come to us with ideas and deals in markets that, either we might not necessarily love or it's too small. So the liquidity is a little bit low there. So we have to really dig in and really understand what the opportunity brings us and what the risk returns are. Because at the end of the day, we're focused on unlevered IRRs first and foremost, because that's the value of the real estate asset. And then, we obviously conservatively put on leverage to get a levered IRR that makes sense. But we look at every deal, and that's one of the good things about the technology. We're able to really disseminate all the deals that we've seen over the last 6, 12, 18, 24 months and compile that, kind of vertical and look at it and say, okay, these are the last 15 deals we've seen in Austin multifamily. Here are the characteristics. Why do we think this one has a better risk adjusted return profile than these? Having that data at our fingertips quickly is really important. That's part of the tech that we're talking about. But we go after those opportunities with those operating partners. And for me, if I look at these deals and I say, okay, we need to be quick. We need to disseminate it quickly. We need to analyze it quickly, and we need to respond to these operators or brokers quickly, because that's how you are successful in acquiring these deals. Obviously, if you call me with a deal that's tied up, that's going to float to the top of the list, Andrew.
Sure.
But like to me, it's 1A and 1B, market and operator. If it doesn't have one of those two, a great operator that we know, or a market that we feel has some real legs and real outperformance and wind at its back, we won't look at it. But if it's got one of those two, we will. And if it's got both, it'll pass through to the top of our funnel. But like a lot of shops, we see a lot of deals,
Yep.
and we probably look at, we probably see 2,000, but really dig into maybe 50 to 100 for every one deal we do.
And are there any asset classes that you're staying away from right now?
I don't like to say that I'm staying away from anything, because again, back to that whole comment, finding a bad micro or good micro deal in a bad macro environment.
Yeah.
We're looking at everything to just make sure we understand what the best risk adjusted returns are in the market today. So we're only US domiciled, and we're basically doing the major food groups within real estate. So, obviously multifamily is probably 50% or so of what we're trying to curate for our portfolio. We do think the demographics for multifamily are still pretty favorable. The financing's a little challenging today, so we're watching that. But we still think multifamily's got some real tailwinds in certain markets, in certain types of industrial, office, which we can talk about, and hospitality. Those are kind of the main food groups. Obviously, there's some subsets of that, like student housing, that we look at and we would invest in. But that's kind of our general, obviously, the universe we play in. So it's really important for us to know. And retail we see and we will look at, but I would say that's a small component. But we need to look at all these asset classes to really understand where they're pricing, where they're valued, so that we can understand where the best risk-adjusted returns are for that point in time. As an example, Andrew, so if you look at our Cadre Direct Access Fund 1 that we just finished investing, we're about to close on the last deal in that fund. We raised about a little over $300 million for that first fund. We've invested in 14 deals, right? When we first talked to our investors about what we think the portfolio would look like, and we launched this right before COVID, so the timing was kind of interesting. But we kind of said, look, 50% would be multifamily, and 50% we would opportunistically look at investing in office, industrial, and hotel, but no retail at the time. And when you look at the portfolio, we ended up doing one office deal, which of the 14, which actually was a life science deal, Andrew, that we bought. It was the first deal we bought in this fund, and it was right after COVID. We closed that deal in the summer of 2020. We've already sold that deal and made north of, I think it was north of a 40% return to our investors for that one deal. So then in that portfolio of 14, we have two industrial development deals, one of which we've actually already completed and sold. It was in Phoenix, Arizona. We made north of a 67% return for our investors on that deal. And then we have one hospitality deal. Actually, I just had lunch with our operating partner at Arbor Lodging. I'll give them a little shout out.
Oh, with Vomsy?
Vomsy. Yep. Just had lunch with Vomsy today.
Well, Vomsy was on Real Talk, and we've done work together, and he's a great guy.
He's awesome. And I met Vomsy through a buddy of mine from college. I feel like, the 6 Degrees of Kevin Bacon, for movies, like I feel like there's certain, vibes coming off that might be 6 degrees for us here, but
I don't even think it's 6. I think it's 2. But
so Vomsy, we have one hotel deal with Vomsy in that portfolio.
Yeah.
And then to finish it off, the rest is multifamily in some capacity. So,
and have you closed on any deals this year?
We're about to next week. It'll be
That'll be your
first deal to close. Yep. It's a multifamily deal in Charlotte.
Multi in Charlotte. Got it. And so what was it about that deal, to the extent you could talk about it, because it's so hard to close any deals right now? And we have some deals that we're closing. We've got multifamily. I have to look at my board. We've got some multifamily deals in Texas and Nashville and a couple in Florida, but it's nothing like it was in 21 or early 22. And so it's one-off deals here, and maybe you find a seller who's who's stressed. Maybe they have a rate cap coming due or loan maturity, and you could take advantage of that.
Yeah, I think that's the most important thing to your point, Andrew. Like, why are they selling? That's the first question I ask my team when they bring a deal and like what we're looking at. Why are they selling? In this instance, it was a developer. This asset's about 5 years old, so newer multifamily. What I like about it is, first of all, the developers usually have to sell because they use that equity for their next, development deal. But what I loved about this, we like the Charlotte market a lot. We think there are a lot of positives going for Charlotte, from population growth to job growth to, obviously the airport expanded a couple of years ago, allowing for the largest planes in the world to land there, which really helped with international travel, which ultimately is leading to more corporations moving there. And there's other things that are happening around Charlotte that we really like. But this asset in particular, newer vintage, larger units. So they're over 1,000 square foot on average, which when you looked at the headwinds of that type of an asset 2 years ago, you were competing against new homes. But now when you look at where the mortgage rates are and you look at the cost of home ownership, the gap between rent to buy has become massive. And so we feel like the headwinds have really mitigated on this asset. So we like the larger units. We like the location within Charlotte. We like the overall macro market. We like the seller. But most importantly on this one, we assumed 9 years of financing at 4%. It's a fixed rate loan. We're day one positive leverage. The LTV, you would think, if you assume debt like that, it would be a low LTV. It's actually closer to a 57, 58% loan to value. So we're still getting good leverage here. And we feel like it's a good cash flowing asset with some upside operationally with our institutional partner that's going to come in here and really push the asset. But we really like the market. We like the fact that I think we're ultimately, when you all said and done, it's going to be like over a 5 cap when we close. The growth is still there. We're seeing rent pop, and we're also buying this 25% below replacement cost, Andrew, and 15% below where they had tied it up a year ago. So we're getting it at a discount from where the market was. We feel replacement cost is something that is important, but less important because there's going to be fewer and fewer new supply going forward, because it's just more expensive to borrow from a construction lending perspective and harder to get construction financing, but also cap rates went from 3 to 5% overnight, and the yield on cost didn't really move much. Costs are coming down a little bit in some markets, but we're not seeing that in Charlotte. So the spread between your unlevered return on cost and where cap rates are today just don't make sense for the risk of new development. So we do feel like over the next 12 to 24 months, we're going to see a real slowdown on new supply coming to the market.
So, based on that analysis, you can understand why Cadre is revolutionizing the real estate investing world. A couple remaining questions, because I want to get you out of here and get to your steak dinner at Gibson's. Yeah. By the way, do you live in Chicago or do you live in Miami?
I don't live in either of those. No, I live in the suburbs of Chicago.
I thought you lived in Miami for some reason.
No, we got our main offices in New York. We've got a group of talented people here with me in Chicago, and I'm on the airplane. I live at O'Hare.
Why did I think you lived in Miami?
I don't know. Maybe because you thought Melissa Rose, Dan Rosenbloom, Melissa moved there. I didn't move there.
Oh my God. That's why before I talked about the heat. Okay. So, I don't even know I
just threw you for a loop, man.
You screwed me up. I thought you were all Miami. Now we could have talked about Chicago, where I was for 7 years.
I live in the North Shore of Chicago, and
that's my hood, my old hood.
Yeah, I live and then I commute through O'Hare quite a bit. So I'm on airplanes.
I know you went to Northwestern for business school, but you weren't smart enough to go there undergrad, and you ended up in Madison. And so not only
you're going to piss a lot of real estate guys off, Andrew, with that comment.
So not only did you go to Wisconsin, not only did you go to an inferior academic university, you went to a school with an inferior basketball team and football team to Northwestern.
Oh my God, Andrew. I think I got to go. I would like to see over the last 30 years
the connection. We're losing the connection.
I will say I took my son to the Northwestern Wisconsin basketball game in Northwestern. This year you had our number, no doubt about it. Over the long run, though, I'd like to go add up the wins and losses over the last 30 years and see where we shake out.
As an investor, I only look to see what have you done for me lately and the type of returns you're doing for me. And so in late March, I know that Northwestern was playing basketball, and I think Wisconsin was not.
Yes, no, actually, see, you got to do more due diligence, Andrew. Wisconsin was actually playing basketball in late March. We were in the Final Four. It just happened to be the
Oh, of the
NIT.
NIT, of
So,
the NIT. All right, last question here.
yeah,
You had a successful run at your prior private equity company, which I know well, and you said Cadre's been around for 8 years, and I think you've been at Cadre almost since the beginning. What made you make the leap in going to a company that uses technology that a much different animal within the real estate business than what you previously had?
yeah. So I spent 11 years at Gem Realty Capital and love those guys. I grew up with them. The CIO Barry Malkin, respect the hell out of. He's a great investor, and I learned a lot there. At the end of the day, like I have an entrepreneurial bug, Andrew, and I wanted to kind of go help really build a business. The technology side, I will tell you, I came in with very little knowledge, and it was a steep learning curve. And looking back from a personal perspective, meeting a lot of engineers and people that I would never have met had I stayed in kind of the traditional private equity real estate world, has been, from a personal perspective, enriching. But it's just something from my standpoint where I said, hey, look, at the end of the day, we're going to build a really good investment platform. I thought we could do that. I thought with, the team that we were building and in my background, I thought we could really build out a good real estate investment firm. And the technology to me was something that augmented a lot of what we were doing. And I thought was pretty exciting. And I didn't have a lot of, base knowledge and I guess, it wasn't really what drew me as much as, kind of being in an exciting industry and saying, look, technology is something that obviously our industry needs. There's a low bar for the use of technology within the private equity real estate world over especially 7, 8, 9 years ago. And I thought, hey, if these tools can help us be a better investor, I'm going to kind of go in and go do a little bit of a blind faith there. But the talent that Ryan Williams, who started our company, brought to the company at Cadre on the technology side of the world has really, kind of looking back, made me look a little smarter. That I took that leap of faith. But for my own personal reasons for doing it was my entrepreneurial bug and the fact that, look, technology is extremely interesting, and I thought technology really can help transform our marketplace. And I thought this was a really interesting way of doing it where I could bring my own expertise to help augment that technology. And that's kind of why I did it at the time. Looking back over the last 7 years, kind of being at Cadre, just looking at it, bringing in talent from firms like Carlyle Group. When I bring in whether it's an acquisitions professional, asset management professional, and they say to me, "Oh my God, this took me and my team 10 times as long to do." That's something that's I think has been pretty rewarding to be able to kind of come in and really change a little bit of what we're doing. I think the landscape's moved a lot over the last 7, 8, 9 years. I think a lot of the private equity real estate funds are starting to adopt technology in different ways. But to be on the forefront of it was pretty exciting when I joined.
Yeah, well, it makes sense. I mean, look, I obviously have an entrepreneurial bug in leaving Big Law and you leaving an established real estate private equity company with an amazing track record. It takes courage, guts, maybe being naive. I don't know, but and I know a supportive spouse, family, and all of that. And you guys have been extremely successful, even though you haven't transacted with Sklar Kirsch either for or against. So you haven't really truly been successful until we transact either for or against.
Well, the against part, I've always said I won't do a deal if you're against me because I'm just too nervous to go up against.
Oh, you're going to be well represented because I know him well and he's a good buddy also. So the fact that I didn't even know that you lived in Chicago and thought you lived in Miami shows how we need to catch up.
Maybe it's just the tan that just gave you the vibe of Miami, but I doubt it.
No, you can replicate that from the fake bake shops that you go to in Chicago.
Nah, I just get on airplanes and go to California and Florida in the summer or the winter.
Yeah.
In the winter.
All right. Well, I'm going to dispense with the world famous lightning round of real talk for when we do episode 2, the sequel with Dan Rosenbloom.
Okay.
And look, I truly appreciate you coming on. I know you have a busy schedule, and best of luck with Cadre, best of luck with the Cubs, best of luck with the Badgers, except when they play Northwestern. And yeah, thanks for coming on.
Yeah, thanks, Andrew. I appreciate it. And we're going to have to get your facts straight next time. So, no, I appreciate you taking the time to bring me on here. And I'll be out in California in a couple weeks, so I'll give you a shout.
Let's definitely get together. All right, Dan, take care.
Later, Andrew.
Bye-bye.
You've been listening to Real Talk, Real Estate Discussions with Andrew Kirsch. You can catch prior episodes at scholarkirsch.com and on YouTube, LinkedIn, Apple Podcasts, Spotify, Google Podcasts, and more. Thank you for your positive reviews, comments, and for sharing this show with others.